So the goal here of this presentation is to educate you, right? Make sure you know what's going on in the market, have you understand our investment process and our outlook. On your table is a list of definitions, if you could circulate those. So those basically just describe some terms that we're using here. Hopefully we're explaining things in a way that is understandable. So, one of the questions that we get, as Ryan was talking about, are we in a recession, and also are we in a bubble, right? So we want to talk about that. As Steve was mentioning, where we stand right now from our perspective, this is a standard normal correction that is actually healthy for the markets. So if we're going to talk about bubbles, I think it's appropriate after last year, wrong way, to talk about Bitcoin, right? So this is actually an article from the New York Times. Everyone is getting hilariously rich and you're not. So the one gentleman, millennial on the right-hand side, has Bitcoin on his sweater, and the other one is Ether, which is another cryptocurrency. So I'm sure you know some millennials that maybe put some money in there and have done quite well. So, when you talk about any cryptocurrency in Bitcoin, it is absolutely a bubble. Now, I don't know if it can go higher or not, but if it started here last year below $100, and then at one point last year hit $20,000 per coin, then of course since then declined below $6,000 per coin. That is a bubble. What I would say, we get a lot of questions regarding that. Certainly it's a speculative investment by all means, when it's hard to say what the purpose of the coin is for. And what we would say is the underlying technology, what's called blockchain, there really can be some value to it, both in the corporate world and perhaps in some sort of cryptocurrency. And the concept of this cryptocurrency could actually make sense in the future. But I think it's safe to say that wherever we stand now, we're in the very early stages of this. So I think volatility is going to be here to stay, certainly with cryptocurrency. So this quote we brought up last year, and I think it's a great one to kind of understand where we are in this market cycle. So it's by Sir John Templeton. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die in euphoria. And I think right now, it's probably safe to say we're in the optimistic stage, right? And when we're looking at this, we're trying to look at a lot of different factors that help us gauge where we are in this economic cycle, but also in this market cycle. So this graph, what we're looking at here are two items. The bars that you see right here are net flows of money either into equities, if it's up top, or out of equities. So this means if you see the bars below, there's money actually in net flowing out of equities. And what you see is from 99 all the way to 07, a lot of money flowing into equities, right? That's money pushing the market up. Even in 03, except for that one exception, all the way through 05, 06, 07. And then what you see is after the Great Recession, a real mixed picture, right? And what that shows me is, even though the market's been really rallying, and you see the S&P, that's the line there, it's done very well over the last 8 years. Really, you've had a lot of mixture as far as money going in and out. And that's showing me that as far as the retail investor, there's not a lot of optimism in this bull market. And even more recently, you're not seeing that. So I think we're in the optimistic stage, but certainly not in the area of euphoria. So we get this question a lot. If people who have cash or if they're invested, hey, and they're saying, we're hitting market all-time highs. This is making me concerned. And what we try to say is, all right, let's just say we're wrong. We don't think there's a recession. We don't think there's a bubble, but we're not, we don't know everything. We could make a mistake. What if we're wrong and we're on a market high? Let's look at historically other situations where there was a market correction and what happened if you stayed invested, right? So 1987, as Steve mentioned, you had the Black Monday. The market dropped 23% in one day. That's not a good day. But what if you stayed invested, right? You didn't change. You were in the S&P 500 and you stayed invested. Your annualized return, so this means year in, year out, over time, up until now, you would have earned 9.6%. So as Steve mentioned, the historic return for the S&P 500 large cap is just around 10%. So again, even with that one, you would have gone through the tech crash of 2000, September 2008, and you still would have earned 9.6%. Let's say you had money in March of 2000, right before the tech bubble popped, and then 9/11. And let's say you kept the money invested. You went through that crash, and then September 2008, your annualized return, 5.7%, right? And there could have been many people out there who went to cash, around that time, or some other point that would be even less advantageous. Or look more recently, September 2008. Let's say you're putting cash in the market high in September of 2008. And then let's say what happened if you kept invested? Your annualized return, 7.5%. So the point here is, we don't have any crystal ball. We don't know the future. We don't think there's a recession. We certainly don't think there's a bubble. But even if you're a long-term investor, these numbers show you that even if you happen to be put money in at the market peak, over time, it's going to come back and it's going to pay dividends for you. So as Ryan mentioned, when we're trying to understand where we are in this business or market cycle, we want to be looking at forward-looking indicators, and he mentioned a number of them. And we're looking at a lot of different ways that they're correlated. So what this graph does, the blue line is unemployment. So you can see that in recessionary times, it peaks, and then now we're coming down to 4%, where you can see on the far right-hand axis. The white line is wage growth, and as Ryan mentioned, we're still fairly low in wage growth, just over 2%. And what you see down here, this is the S&P 500. And what happens is when you have wage growth approaching 4% and coming up to unemployment, in two different cases, that's when the market peaked. So we're looking at where do we stand with wage growth versus unemployment. And if we get to a point where unemployment gets down into the 3% range and wage growth gets closer, then we're going to be looking to say, hey, now this may be indicating that we could be more in a recessionary period. But where we stand right now with wage growth and unemployment, we don't think we're in that period right now. So again, from an education perspective, we occasionally talk about the concept of a yield curve, right? You may hear that in the news. So I want to just kind of go through that and what you need to be aware of when you hear that term. So this bottom graph right here, chart, that is what's called a normal yield curve. And what a yield curve does is just looks at the interest rate that you can get from a bond over the same credit quality, right? So the same credit quality for the bond, but over different maturity levels. So we start out at 1 month here, going all the way out to 30 years, right? So it makes sense that if you're going to lend somebody for 30 years, you're going to want a higher interest rate of repayment. And if you're going to lend somebody for 2 years or 6 months, you're willing to take less money in interest. So the bottom one is a normal yield curve. The middle one is where we stand right now, right? And you hear the concept of a flattening yield curve. And you can see we're a little bit more flat on that yield curve. The top one is what's called an inverted yield curve. And that one, the short-term rates are above the long-term rates, right? And from our perspective, a flattening yield curve is not necessarily a problem. An inverted yield curve, that's where it can be more of a problem. And I say that because what this chart shows you, it's a little bit complicated, but I think it's really valuable. The blue line is the S&P 500 going up over time. The purple line is the difference in the yield curve, right? And what happens here is wherever you see an orange bar, that's where the yield curve became inverted. And the gray bars is every time a recession occurs. So in all these different times where you have an inverted yield curve, what follows next? A recession. So again, where we stand now, we do have a flattening yield curve. But even in the last month, that yield curve has become a little bit steeper as long-term rates have gone up. But right now, we're not concerned when we're looking at that yield curve. It's not an inverted yield curve, and that's, from our perspective, what we really want to be paying attention to. Of course, when we talk about risk, there's plenty of geopolitical risk out there. This is a list of them. It could be elections in Germany or Italy this year, obviously North Korea, anything in the Middle East. And one of the things we do want to stress to you is that we live in a world of risk, right? And I can talk about some of the risks that we see out there, but there's a whole slew of other risks that I won't even mention that could come up this year. So I think it's important that, as we are in this world of risk, that you don't become too bullish, right? And we see that sometimes, which is, after the market being up, somebody who's a balanced investor, now they want to become a growth investor. And we say, well, is this the right time to do that? So always just take stock, where do you stand in your life, and understand that there could be something that comes up that's unexpected, and certainly the geopolitical risk can become problematic. So as we're looking at these three risks, Ryan talked about, and Steve talked about inflation and the concern that the Fed could start raising rates quicker. We don't think where we stand with interest rates is a problem, but it could become a problem. Certainly a trade war, right? There's certainly historical precedent that if a trade war does ratchet up, if we do leave NAFTA, that could become more of a problem to the markets. And I mentioned geopolitical risk. So those are the three ones that we're looking at right now that could change our perspective on the markets and the economy. The one thing I want to talk about real briefly is the national debt. We had this question and concern that came up in the Saratoga event, and I think it's a valid one to discuss. So, you know, with the recent tax reform bill that could potentially increase the national debt and the most recent budget and debt package that was passed that would also potentially increase the national debt, we are getting to a point, so right now, as a percentage of GDP, we're at around 75%, give or take. And you can see, you know, except for after World War II, we're hitting at some all-time historical highs. And that's, you know, as finance folks, that's not a good thing, right? You know, whether you're a family and a household, whether you're a company or a country, you want to manage your debt. And having too much debt is not a good thing. But from a portfolio perspective, there's nothing that we are doing to adjust our portfolios because of it. Because the way we view this is the issues are more long-term. Right now, probably nothing's going to happen as far as the economy or the currency or anything. But as you go farther out, this goes out to 2046, so it's just an estimate, it's a forecast. But what you have happening is entitlements, Medicare, Social Security, and the baby boomers are, you know, will be increasing in those amounts. It becomes a problem. So from a portfolio perspective, short term, next 3, 5, 10 years, not necessarily a problem. As we go out, and if that continues to increase, it's definitely a problem. You can have a situation where you have higher inflation, declining dollar. You know, it can impact things in a pretty significant way. So, but we want to let you know that we're not making any adjustments to the portfolio because of this, but it is a concern that we're always looking at.